Hello, it's Friday the 8th of July. I'm Simon Whitney. Welcome to issue 39 of Travers Smith's Alternative Insights. And this week, we're looking at the benefits of well-structured continuation funds. Although some recent press commentary may suggest otherwise, the rise in so-called continuation funds, or as the FT has labelled them, sell-to-yourself deals, is a healthy sign of a maturing market. Of course, there are issues that need to be carefully navigated, not least the inevitable conflicts that arise, but these are familiar and manageable issues. As we discussed at our inaugural Alternative Insights Summit last week, an appropriately structured deal can lead to a win-win-win for the investors, the fund manager, and the target assets. Much of the private capital universe focuses on relatively long-term investments in illiquid assets. For investors who do not need short-term unplanned liquidity, which includes most institutional investors, the most efficient way to invest in such assets is through closed-ended pooled investment vehicles. As the private markets have grown, a huge number of assets are now held in that way. And as European policymakers have acknowledged, that brings significant advantages for the real economy, as well as for institutional investors and their ultimate beneficiaries. But investors need liquidity at some point, and one way to achieve that is for the fund to have a fixed term, in practice usually around 10 years. That means that at some point, the fund will have deployed most of its capital, leaving the assets held by the fund with limited access to follow-on funding, and the fund manager or general partner or GP with only a few years left to generate value and sell the investments. The fund is effectively a forced seller at some arbitrary point in time. For most investments, that doesn't matter. The business model of private equity assumes that significant changes can be made over the course of the expected holding period and the asset made ready for sale within the fixed life of the fund. But when that is not the case, and an asset would benefit from more time and maybe more capital, the secondary market allows a fund manager to offer a liquidity option, effectively the right for investors to receive cash within the existing fund term, or if they prefer, to retain exposure to the asset through a longer dated vehicle that has greater access to follow-on capital. Although not the only solution, in many cases, this is the structure that allows the most flexibility for the fund manager and the investors, with the least disruption to the underlying business. It is, of course, critical that all investors are properly protected. There are robust and tried and tested processes underpinned by existing and forthcoming LP side guidance to ensure that conflicts are identified, transparently managed, and in particular, that there is an objective price discovery mechanism. Fund managers have contractual, fiduciary, and regulatory responsibilities, and they are sharply attuned to this issue, while investors and regulators, most recently the US SEC, have been clear that these transactions will be closely watched. The first priority for a GP looking at a continuation fund deal is to explain why it considers that to be the best option for investors. In many cases, a deal can fail at that first hurdle, but often the GP will have a compelling edge over the market. For example, the GP may know the asset and its sector better than anyone else, reducing buy-side risk. The GP might have a well-established and productive relationship with the management team that wants to avoid the business disruption of an M&A deal. Or it might have bolt-on acquisitions in the pipeline that will generate significant further upside, but require additional equity financing. These and other factors might drive up the price to the benefit of exiting LPs. But having established that it may be in a position to pay more than other prospective buyers, the GP needs to demonstrate that it can structure and execute a transaction that works for all parties. In almost all instances, this will involve an intermediated auction involving the secondary market. And increasingly, this now involves consideration of third-party private equity sponsors and even trade buyers who might be interested in a minority sale with the continuations fund's participation set by reference to the price established in that way. In most cases, the Limited Partner Advisory Committee, or LPAC, will have to waive conflicts in respect of the deal and will insist on a third-party fairness opinion. If they do not insist on that, it's generally because there is an alternative, even more robust way to benchmark the price. Next, the GP should focus on future economics to build strong alignment of interest. Typically, cash received by the fund manager's team on the sale, carried interest, and any GP commitment is reinvested. That helps to demonstrate to a secondary buyer that the fund manager believes in the upside, again, helping to drive up the price for the benefit of selling investors. It is also important that the terms of the continuation fund are not price dilutive for the buyer. Typically, this means a low management fee and perhaps a higher hurdle, or a lower carried interest rate, which ratchets up if there is outperformance. The standard 2 and 20 model is not in play here. The LPs who choose to roll over may take significant comfort from the fact that a highly sophisticated secondary fund is willing to commit on similar, or sometimes worse, terms. Getting ahead of the process is vital. Some conflict waivers will be required from the LPAC, and their early involvement is therefore advisable, with regular updates as the deal progresses. LPs will also need enough time to properly consider their options, usually at least a month. Documentation should carefully, fully, and fairly analyse and disclose all conflicts of interest and describe how they have been managed. Single asset GP-led deals are not easy to do, and investors and regulators rightly expect an open and fair process. But as long as some widely accepted principles are applied, there is no reason to inhibit deals from which everyone, including, importantly, the underlying operating business itself, can do well. Thank you for listening. If you would like more information on this topic, please check out our website, where you can also sign up to receive future editions of these insights, or drop me an email at simon.whitney@travissmith.com.